Shall now carry on with Chapter 8, Capital Asset Pricing Model and Introduction. CAPM is a model that describes the relationship between risk and expected return, and that is used in the pricing of risky securities. The general idea between CAPM is that investors need to be compensated in two ways: time value of money and risk. CAPM is a method of share valuation developed by William Sharpe in 1964. It is based on a linear relationship between risk and return. Linear relationship relates to the higher the risk, the higher the return should be. It is a development of portfolio theory. It is an extension of portfolio theory. It considers systematic risk is the only relevant risk when valuing shares. Under portfolio theory, Markovitch used standard deviation, which considers total risk. CAPM asserts that the only risk that is priced by rational investors is systematic risk, because that risk cannot be eliminated by diversification. As we've seen earlier, under portfolio theory, you can eliminate unsystematic risks, but you can never eliminate systematic risks. The portfolio theory considers total risk of return and returns of portfolio, whereas CAPM uses systematic risk of individual securities to determine the fair price of a security. In order to ignore the influence of unsystematic risk, we can assume that investors have already eradicated unsystematic risk by holding a diversified portfolio. A diversified portfolio would mean if the investor holds between 25 to 30 individual shares from different sectors of the stock market. You must understand that CAPM is built on a few assumptions. The assumptions are: investors are rational utility maximizers. What that means is that investors need a return on their investment. Information is freely available. Unfortunately, there's some information that you have to buy, which is not freely available. All investors have similar expectations: risk-return trade-off. Low risk, low return; higher risk, higher return should be. Investors can borrow and lend at the risk-free rate. As you know, in Malaysia, the risk-free rate stands around 3 to 3.5%. Investors hold diversified portfolios, thereby eliminating all unsystematic risks, which is also known as diversifiable risks. Some of these assumptions are true, while some of them are not true. Moving on. Again, on CAPM assumptions, the capital market is perfect. In reality, capital markets are not perfect. Under perfect market conditions, there will be no taxes, no transaction costs. However, in real life, there are taxes that exist for stocks market in Europe, in America, whereas in Asian region, there are no taxes. Transaction costs: every investor pays transaction costs when buying or selling. Free entry exit: this is very true. There are many buyers and sellers. This is also very true. Information is costless and freely available, Unfortunately, this is half true, as some information you have to pay a price for the information. CAPM is also assumed to be a single period transaction horizon. What that means is usually taken as 1 year. Central to CAPM is the existence of a linear relationship between risk and return. Earlier I explained high risk, high return, low risk, low return, defined by the security market line, SML. Please note that the SML is very different from the capital market line, CML. The CML exists in portfolio theory. The SML exists in CAPM, where systematic risk is compared with the risk and return of the market and the risk-free in order to calculate the required return for the security and hence a fair price. If you notice the next slide, this is how you draw the CAPM, and this is basically the CAPM formula. Right, to explain the security market line, the security market line is a graphical representation of CAPM, and it plots levels of risk against the expected return of the entire market at a given point in time. Next slide. CAPM components. Basically, these are the components representing CAPM. They are the risk, the return of the market represented by RM. In Malaysia, the return on the market is represented by the KLCI, which you have done in your assignment. The risk-free rate of return, in this case represented by the 3-month Treasury bill, which you have also done in your assignment. The equity risk premium, RM, return on market minus the risk-free rate. And last but not least, more important, is the beta of ordinary shares of a company. These are the 4 components that represent CAPM. We will now look at each of the components, starting with beta. By definition, beta is always and acts as a benchmark against which the systematic risk of securities can be measured. Beta of a security measures the sensitivity of returns on the security to changes in the systematic factors. The market beta is always considered to be 1. You will always compare the beta of the stock of the company against the market beta, which is 1. If you look at the slides, beta is seen as an index of responsiveness of changes in the securities returns relative to changes in the market. Take for instance, if your beta is 1.5, the market beta is 1. If the market rises by 10%, it means that particular stock measured beta is 1.5 will move by 15%. An example is given here below. Please understand what beta represents. Beta is a measure of the volatility, the systematic risk of a security or a portfolio in comparison to the market as a whole. Used in CAPM, that calculates the expected return of an asset based on its beta and expected market returns. I must add, it also based on the risk-free rate. Moving on, the formula to calculate beta is this formula highlighted. Or if you want, you can use a graphical method. Beta can be found by regression analysis of security returns against the market returns. Okay, beta can be found from a line of best fit of a plot of security returns against market returns. You can see in the next slide where this is how beta is calculated using regression. Basically, in order to measure beta, you measure the slope of the line. Alternatively, you can use the formula method which is given in this slide here. You will arrive at a similar answer for both methods. Moving down, you can see examples of beta for UK companies. You notice Barclays has a beta of 1.17. Barclays is a bank. BP stands for British Petroleum. It has a beta of 0.75, lower than the market. Kingfisher is a beer company. Beta is 1, equal to market. Tesco 0.49, a supermarket chain who has a beta of 0.49, much lower than the market beta of 1. This is the way how you calculate a portfolio beta. It depends again, as I said, the weights. The return of the market is represented by the KLCI as per your assignment. It is a representative of the market. How the market performs, we look at the KLCI for an indication. Earlier when you did the assignment, I'm quite sure the KLCI you took as 1005. Now the KLCI stands at 1300, a drop of 200 points because of the COVID-19 virus. The next is equity risk premium, represented by the return of the market minus risk-free rate. In Malaysia, after you've extracted it from Bank Negara website, you are able to calculate the equity risk premium, RM minus RF. The risk-free rate is represented by the 3-month Treasury bill rate. Notice I mentioned 3-month Treasury bill rate. No assets are totally risk-free, but bonds issued by the government of stable countries are seen as almost risk-free. Next slide shows you an example of how to calculate CAPM, represented by the required return of a security. Using the formula that was provided, you will notice that the required return of British Airways, if you invest in British Airways, is 10.25%. meaning to say, if I invest in British Airways, I require a return of 10.25%. What my actual return is will be different from 10.25% depending on how British Airways performs. Implications of CAPM. Investors will require compensation only for systematic risk. That is what CAPM stands for. Because unsystematic risk can be eliminated by portfolio diversification. Again, I will mention, by investing in between 25 to 30 stocks, you can eliminate unsystematic risks. However, you are not able to eliminate systematic risk. Systematic risk is caused by factors such as interest rates, inflation, political events. Even war is considered part of systematic risk. Whatever you do, you will not able to eliminate completely systematic risk. Going on the risk-return trade-off, securities with high levels of systematic risk should on average yield high rates of return. High risk, high return. A linear relationship should be developed between systematic risk and return. In order to measure systematic risk, we use beta. If the beta of the company is high, the return of your investment should be high as well. Fourth point, correctly priced security should plot on the security market line. If the security is correctly priced, the required return of that security and the expected return of that security should equal one another. Only if the required return and expected return are not equal one another in an efficient market, this is what will happen. At point X, the security is underpriced. When the security is underpriced, investors will jump in to buy the security, hence causing the price to rise and return decreases. So you notice from X here, when investors buy the security, it will move down to the upward sloping line. On the other hand, if you are at point C, meaning to say C is overpriced, investors will sell the security, causing the price to drop, and hence C will return to the straight upward sloping line, hence making it efficient again. I've given you an explanation down here. Security B is correctly priced. You can notice where security B is on the line. Security A is considered underpriced, giving higher returns compared to those required by investors, given its level of systematic risk. Therefore, investors will buy, causing price to rise and its return to decrease. Security C is overpriced, hence the opposite will happen. That concludes CAPM. For this particular slide onwards, we will not be covering CAPM and investment appraisal. Please note, from this slide onwards, we will not be covering CAPM and investment appraisal. Thank you.